At the recently concluded Business Standard Annual BFSI Insights Summit, industry doyens shed light on the best ways to navigate financial markets amid global macroeconomic uncertainties entangled in geopolitics. Christopher Wood, the global head of equity strategy at Jefferies, is optimistic that India could soon emerge as the next big manufacturing hub in East Asia. However, to be able to do that, along with ensuring stability in financial markets, Indians should stand pat and watch out for the 2024 general elections to pass, suggests Woods. Indian stock market, he believes, could see a 25% correction in 2024 if Bharatiya Janata Party does not return to power.
I wouldn't want to own the Indian market on leverage before the election.
Okay.
Because the message from 2004, because if my memory is correct, nobody expected that result in 2004.
Okay.
Correct?
Okay.
But I agree, the momentum is such that it will bounce back, that there will be a big correction. But obviously that's very much the unlikely outcome, but we have to admit that risk exists.
While the elections could lead to short-term volatility in financial markets, fund managers at the event said it is macroeconomic factors that drive markets at the end of the day.
But when you look at in India, say in the recent history, the redeeming factor is elections have not necessarily led to any significant change in economic policies. And I think the same thing applies today. As Naren mentioned, it could create intermittent volatility, but to the extent that there is no directional change in the macroeconomic policies being pursued in the country, it should not necessarily impact financial markets.
Christopher Wood, however, cautioned investors against higher US Treasury bond yields and said that US rates may remain higher for longer, thus increasing private equity and credit risks. For now, there is no reported decline in private equity investments in India. Experts said India has increasingly become a favored destination for investment in the Asia-Pacific region, and that private equity investments have doubled over the past 2 years in the country.
15 years ago, if you looked at just a few indicators, big macro indicators, private equity accounted for under 1/4 of foreign direct investment in India. Now, in the last 3 years, despite the volatility that Renuka referred to, private equity and venture capital accounts for over 2/3 of foreign direct investment in India. So it's actually become the most important source of long-term capital for this country. And that, I think, is something which is very important when we think about, which way the economy is heading and what the drivers of engine of growth for this economy are.
Addressing industry leaders, RBI Governor Shaktikanta Das spoke on investments in government securities and emphasized the significance of Indian bonds being included in the JP Morgan Global Bond Index. The inclusion stands as a vote of confidence for India's financial markets, he said.
Our effort over the last few years has been to sort of expand the investor base in our securities market, especially the government securities market, to expand the investor base, and also to provide, sort of greater opportunity for participation. We have taken number of steps. You mentioned about the fully accessible route. We have also taken several other measures. You alluded to a few. And there is this also things like, for example, we have, permitted the banks, the domestic banks, to offer margin facilities to the FPIs, etc. Now, inclusion of India in the JP Morgan Bond Index is their decision. And the first thing that has to be recognized in this is that it's a kind of a vote of confidence about the Indian economy and about the Indian financial markets.
India's stable banking sector enabled the Indian economy to withstand global headwinds. The country's largest public sector bank, State Bank of India, has a grand portfolio of 60 trillion rupees worth of assets. SBI chairman Dinesh Khara expressed his confidence in the Indian economy and sees no asset quality risks in the foreseeable future.
Banks have significantly strengthened their underwriting practices. And when it comes to macro, I would say that macro is doing well. So there are hardly any challenges. But at the same time, I must also mention that at least as a bank, the practice which we are following for quite some time is to ensure that our balance sheet should be shock-free from any such asset-related stress. And we are rather, I would say, much more pragmatic in terms of providing for, or maybe more aggressive in terms of providing for any likely stress in the balance sheet.
In the face of global uncertainties, experts believe that Indian financial markets performed better than most global economies. To beat the volatility, the best bet for now is to explore potential in domestic markets.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
She's working her way to the corner office. Business Standard.